Silver price warning. Be prepared. For $300 silver in the future. Somewhere in a vault, a number is being quietly recalculated. Not by a trader, not by a headline writer, by the people who move billions before the public even notices. For decades, silver was treated as gold's smaller, forgettable cousin. Cheap. Overlooked. Ignored by the institutions that mattered. But something has shifted. Industrial demand is colliding with a supply gap that has been ignored for almost 20 years, and the very people who once dismissed silver are now positioning themselves before the public catches on. This is not speculation, this is a pattern, and patterns historically do not lie. What happens next may not just change the price of silver, it may change who holds the real wealth when the next decade begins. Now, before going further into this story, a small favor. The kind a neighbor might ask, not a stranger. If you find value in what's shared here, consider clicking that subscribe button. It costs nothing, takes only a second, and it genuinely helps this channel continue bringing serious, honest analysis to people who care about protecting what they've worked for. And one more thing, we'd love to know, where in the world are you watching this from today? Drop your city or country in the comments below. It's always remarkable to see just how far and wide this community truly reaches. Now, let's get into exactly why $300 silver is no longer just a theory. For most of modern financial history, silver lived in the shadow of gold. While investors lined up to buy gold bars and gold coins, silver was treated as something smaller, something less important. Analysts often called it poor man's gold. It was cheap, it was easy to ignore, and almost nobody believed it could ever become a serious source of wealth. But history has shown again and again that the most overlooked assets are often the ones that surprise everyone later. To understand why silver may be heading toward $300 an ounce, one must first understand how the world arrived at this point. Silver is not just a precious metal sitting in vaults and jewelry boxes. It is one of the most important industrial materials on the planet. It conducts electricity better than almost any other metal on Earth. It is used in solar panels, in electric vehicles, in medical equipment, and in nearly every piece of modern electronic technology. For years, this dual identity confused investors. Was silver a safe haven like gold, or was it an industrial commodity tied to factories and manufacturing? The truth is, it was always both. And that dual nature is exactly what makes silver's story so unusual. In the early 2000s, silver traded for just a few dollars an ounce. Few people paid attention to it. Mining companies slowed their investment in new silver projects because prices were too low to justify the cost of digging it out of the ground. Why spend money exploring for a metal that barely covered production costs? This decision, made quietly by mining executives 2 decades ago, created a problem that the world is only now beginning to understand. While demand for silver kept rising every single year, especially from the technology and renewable energy sectors, the supply of new silver barely grew at all. Old mines slowly ran dry. New mines were rarely built. And for years, almost nobody noticed the widening gap between how much silver the world needed and how much silver the world was actually producing. This is where the story becomes serious. According to data tracked by major industry analysts, the world has now experienced multiple consecutive years where global silver demand has outpaced global silver supply. In simple terms, more silver is being used than is being mined. This kind of structural deficit cannot continue forever without consequences. Inventories, the stockpiles that exist to cover shortfalls, have been quietly shrinking. For a long time, large investors and institutions did not seem worried. Silver remained relatively cheap compared to gold, and most retail investors paid it little attention. It was treated almost like a forgotten asset, something from the past with no real future. But quiet shifts began to happen behind the scenes. Large industrial buyers, particularly those involved in solar panel manufacturing, began locking in long-term silver supply contracts. This is something that does not normally happen with a metal nobody believes in. Why would a company secure years of future supply unless they were genuinely worried about not having enough? At the same time, central banks and major financial institutions around the world began increasing their exposure to precious metals in general, as global debt levels rose and trust in paper currencies came under pressure. While most of this attention went to gold, silver quietly began to benefit from the same forces. This created an unusual and important moment in financial history. An asset that the public mostly ignored was being slowly accumulated by people who do not make decisions based on emotion. Institutions, manufacturers, and serious long-term investors do not buy assets for excitement. They buy them because the numbers tell a story that the average person has not yet noticed. This is often how major financial shifts begin, not with headlines, not with sudden announcements, but with quiet, careful positioning by those who study supply, demand, and long-term trends long before the rest of the world catches on. Silver, for years dismissed as the lesser metal, was quietly becoming something else entirely. The question now facing serious investors is simple. If industrial demand keeps rising, if supply keeps shrinking, and if the world's trust in currency systems keeps weakening, what happens next? To understand that, one must look closely at what is happening today, in the present moment, as supply tightens further and the gap between what the world needs and what the world actually has becomes impossible to ignore. By the time most investors began paying attention, the situation had already moved far beyond what casual observers realized. The numbers behind silver's supply and demand were no longer a quiet concern whispered among analysts. They had become a structural reality that could no longer be dismissed. To understand the seriousness of this moment, one must look at how silver is actually consumed in the modern world. Unlike gold, which is mostly stored, saved, and rarely destroyed, silver behaves very differently. A large portion of the silver used in solar panels, electronics, and medical devices is used up. It gets embedded into circuit boards, soldered into components, and sealed into devices that are never melted down for their silver content again. This means that, unlike gold, silver does not simply move from one owner to another. Much of it disappears from the available global supply permanently. Year after year, decade after decade, this slow disappearance has been quietly draining the world's usable silver reserves. At the same time, the renewable energy movement accelerated demand at a pace many analysts did not expect. Solar panel production, once a small market, became one of the largest single consumers of silver on the planet. Each new generation of solar technology required significant amounts of silver paste to function efficiently. As countries raced to meet clean energy targets, solar installations multiplied rapidly across nearly every continent. This created a strange paradox. The world wanted more renewable energy to reduce its dependence on traditional resources, but the very technology meant to achieve that goal increased pressure on a different limited resource: silver itself. Electric vehicles added another layer to this growing demand. Every electric vehicle requires meaningfully more silver than a traditional gasoline-powered car, largely due to the increased number of electrical connections and components. As global EV production scaled up year after year, silver demand from this single sector alone began to rival demand from traditional jewelry and silverware combined. Meanwhile, on the supply side, the picture grew increasingly troubling. The majority of the world's silver is not mined on its own. It is mined as a byproduct of other metals, particularly copper, lead, and zinc. This means mining companies do not simply increase silver production because prices rise. They can only produce more silver if they are also mining more of these other base metals, which depends on entirely different market conditions. This byproduct relationship created a structural limitation that few outside the mining industry truly understood. Even when silver prices increased, supply could not respond quickly because production decisions were tied to copper and zinc markets, not to silver demand itself. Industry reports began to confirm what careful observers had suspected for years. Multiple major financial institutions, including some of the world's largest banks, started releasing analysis acknowledging that the global silver market had entered a multi-year deficit. This is not a temporary imbalance that corrects itself within a few months. It is a structural deficit that requires years of investment, exploration, and new mine development to resolve. And even that assumes new discoveries can be made at all. As above-ground inventories continued shrinking, something else began happening in the background. Large institutional investors, the kind who manage billions of dollars and rarely act on emotion, began quietly increasing their exposure to physical silver and silver-related investments. Their decisions are typically driven by long-term data, not short-term excitement, which made their growing interest particularly significant. At the same time, governments around the world were dealing with their own pressures. Rising national debt levels, persistent inflation concerns, and uncertainty about the long-term value of paper currencies pushed many central banks and sovereign wealth funds to reconsider their reserve strategies. While gold remained the primary focus of these discussions, silver began to receive renewed attention as a complementary store of value, particularly given its dual role as both a monetary metal and an industrial necessity. This combination of forces, a permanently shrinking supply, a structurally limited mining response, and steadily rising industrial and investment demand, created a market dynamic rarely seen in modern financial history. Most commodities experience temporary shortages that eventually correct themselves as producers respond to higher prices. Silver's situation appeared fundamentally different, rooted in decades of underinvestment and a unique consumption pattern that permanently removes supply from the market. The deeper analysts looked into the data, the clearer one conclusion became. The gap between what the world needed and what the world could realistically produce was not shrinking, it was widening. And as that gap continued to grow, the foundation was being quietly laid for a price movement that history suggests could become far larger than most investors currently expect. History has shown a consistent pattern across nearly every major market shift. Long before the general public becomes aware that something significant is happening, a smaller group of sophisticated investors has already begun positioning themselves. Silver, in this current moment, appears to be following that exact same pattern. Unlike retail investors, who often react after a price has already moved, large institutions tend to act before the obvious signs appear. They study supply data, industrial demand forecasts, and currency stability years in advance. By the time the average person notices a trend in the news, these institutions have often already secured their positions. Recent data has revealed a noticeable shift in behavior among several major financial players. Hedge funds, commodity trading firms, and even certain pension funds have steadily increased their exposure to silver-related assets. This includes physical silver holdings, silver mining equities, and silver-backed financial instruments. These are not casual decisions made on impulse. They represent calculated moves based on long-term risk assessment. What makes this shift particularly notable is the type of investor involved. These are not speculative day traders chasing short-term price swings. These are institutions known for cautious, methodical decision-making. When such entities begin increasing exposure to an asset that has historically been overlooked, it often signals a deeper recognition of risk and opportunity that has not yet reached mainstream awareness. At the same time, sovereign nations have also entered this conversation. Several countries, concerned about long-term currency stability and the future of global reserve systems, have begun diversifying their national reserves beyond traditional holdings. While gold remains the centerpiece of most of these strategies, silver has started appearing more frequently in broader reserve diversification discussions, particularly among nations seeking exposure to both monetary and industrial value within a single asset. This is an important distinction. Gold is widely understood as a monetary metal, valued primarily for its role as a store of value. Silver carries that same monetary history, dating back thousands of years, but it also functions as a critical industrial resource. This dual identity gives silver a unique strategic value that few other assets possess, especially during periods of economic uncertainty combined with rapid technological growth. Mining companies themselves have also begun behaving differently. Rather than aggressively expanding new exploration projects, many established producers have shifted toward consolidation, acquiring smaller silver mining companies instead of building new mines from the ground up. This pattern often appears in the later stages of a supply-constrained market, when companies recognize that acquiring existing reserves is more efficient than searching for new ones that may take years or even decades to develop. This shift in corporate strategy sends a quiet but powerful signal. Companies with detailed internal knowledge of geological data and production costs are choosing to secure existing silver reserves rather than gamble on discovering new ones. Their actions suggest a belief that available silver in the ground is becoming increasingly valuable and increasingly scarce. Meanwhile, refining and storage facilities around the world have reported tightening availability of physical silver in certain forms, particularly larger industrial bars used by manufacturers. While this has not yet become a widely publicized issue, those closely monitoring physical metal flows have noted increasing difficulty securing certain quantities without delays. a detail that rarely makes headlines but often precedes broader market tightness. Historically, this combination of institutional accumulation, sovereign interest, corporate consolidation, and physical tightness has appeared shortly before major price movements in other commodities. Each individual signal on its own might seem minor. Together, they form a pattern that experienced market historians recognize from previous cycles, often appearing months or even years before the broader public becomes aware that anything unusual is occurring. The question now is not whether large, sophisticated investors are positioning themselves in silver. The data increasingly suggests they already have. The remaining question is how much longer this quiet accumulation can continue before public awareness catches up with what institutional money has already concluded, and what that awakening might mean for a market this tightly constrained. Every major financial shift in history eventually reaches a turning point, a moment when quiet accumulation gives way to public recognition. For silver, that moment may be approaching faster than most people realize. Consider what happens when a market already operating under a structural supply deficit suddenly experiences a surge in public demand. This is not a hypothetical scenario. It has happened before in other markets, and the pattern tends to follow a predictable sequence. First, informed buyers accumulate quietly. Then, modest price increases begin attracting attention from slightly wider circles. Finally, broader public awareness arrives, often suddenly, triggering a rush of demand that the existing supply simply cannot absorb. Silver's above-ground inventories, the supply available for immediate delivery, have already been shrinking for years. If retail investors, the general public, begin entering this market in meaningful numbers, even a modest increase in buying pressure could overwhelm an already strained system. Unlike paper assets, which can theoretically be created without limit, physical silver cannot simply be manufactured to meet sudden demand. It must be mined, refined, and delivered, a process that takes years, not days. This is precisely why some serious analysts have begun discussing price levels that would have seemed unimaginable just a few years ago. A figure like $300 an ounce is not presented as guaranteed certainty. It is presented as a plausible outcome if current supply and demand trends continue, combined with a genuine shift in public awareness and participation. History offers a useful comparison. Markets that experience prolonged supply deficits, combined with sudden surges in demand, often do not move gradually. They tend to move sharply, compressing years of expected price appreciation into a much shorter window of time. This is sometimes referred to as a supply shock, a moment when the market suddenly recognizes that available supply cannot meet real demand at current prices. For the business community, aspiring entrepreneurs, and serious long-term investors, this presents a critical strategic question. Markets rarely announce these moments in advance. By the time mainstream financial media begins discussing silver's potential, much of the early opportunity may have already passed to those who recognized the pattern earlier. This is not a call for speculation or impulsive decision-making. Rather, it is a reminder that history consistently rewards those who study underlying fundamentals rather than waiting for confirmation from headlines. The institutions, sovereign funds, and mining companies discussed earlier did not wait for public consensus before acting. They acted on data, on patterns, and on a clear understanding of supply constraints that the broader market had not yet priced in. What remains uncertain is the exact timeline. Markets can remain undervalued longer than logic suggests, and structural deficits can persist for extended periods before triggering a dramatic price response. However, the underlying fundamentals, a permanent and growing supply deficit, increasing industrial dependence, and quiet but consistent accumulation by sophisticated investors, remain firmly in place. For those paying close attention, the message is not about predicting an exact price target with certainty. It is about recognizing a pattern that has repeated throughout financial history. Scarcity, when paired with rising demand and growing awareness, eventually finds its true price. Whether silver reaches $300 an ounce or simply continues its steady climb toward fair value, one conclusion remains difficult to dismiss. The forgotten metal, dismissed for decades as gold's lesser cousin, may be quietly preparing to remind the world exactly why it was once considered precious in the first place.